Hello, I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, July 24th. Continuing to have historically challenging times like these can be hard for investors to navigate on their own. So we just want to let you know that Foster Group continues to be here to help. We have over 1,400 clients who we truly care for. It's our pleasure to help with all aspects of their financial planning, how you plan, invest, protect, and give, especially in uncertain times like these. The uncertainty in today's world can sure feel a little bit overwhelming, and sometimes it can be helpful to have a conversation about your plans and investment just to get a reality check or a second opinion. If you're feeling uncertain or you know someone who is and you think we might be of help in having that conversation, we'd sure welcome that. So feel free to forward the email or the information about this video to anyone you'd like, and just encourage them to give us a call. We'd be glad to have that conversation. So let's look at the last couple of weeks here. It looks like the economy and markets have entered a slightly less volatile period as we move into the second half of the year. Of course, it's hard to imagine a more volatile period than what we saw in February through April earlier in the year, in the earliest days of the pandemic and the economic lockdown. Many observers, including myself, we expect kind of continued periods of pessimism and optimism as various economic numbers are reported and vaccine progress is monitored and the U.S. presidential election gets ever closer. The national mood swing, they're likely to continue. And let's just look at the numbers over the last couple of weeks to see examples of this kind of positive and negative. On the unemployment front, initial unemployment claims rose for the first time in 16 weeks last week. They're up about 109,000 to 1.4 million for that week ended July 18th. However, continuing claims, people receiving benefits, actually fell by 1.1 million to 16.2 for the week ended July 11th. The enhanced unemployment benefits that many are receiving, you've heard that talk about additional $600 a week of benefits. Those are set to expire at the end of July. However, Congress is in the midst of a negotiation to see how they're going to extend those. On kind of some good news, U.S. existing home sales rose 20.7% in June over the prior month, as average 30-year mortgage rates fell to their lowest level on record, below 3%. In terms of virus news, and this is probably the single most influential thing on the economy and markets and our day-to-day experience as well, how we're living life. And we're seeing a lot of things happen every day. We see some hot spots developing around the country and around the world. Florida, California, and Texas continue to see some struggles with positive case counts reaching really record levels over those 7-day moving averages. States and communities are implementing various mask and business opening guidelines, and they're really struggling to find ways as they think about school opening in the fall. That has a lot of people's attention. The Trump administration awarded $1.95 billion to Pfizer and partner BioNTech for 100 million doses of a promising vaccine trial that's moving into phase 3. Moderna and AstraZeneca continue toward phase 3 trials as well. Actually, Moderna's phase 3 trial started on Monday, July 27th. And that Operation Warp Speed that we've mentioned a few times, the federal government's goal to not only fund the research to develop the vaccine, but as they identify the vaccines that are going to work, to have enough money in place to produce literally hundreds of millions of doses right out of the gate. They continue to look forward to that goal, and they continue to talk about the end of 2020 or early 2021 as possibilities to have hundreds of millions of doses of these promising vaccines being produced, if some of them turn out to really be as effective as people hope in these phase 3 trials. In terms of how the market is responding to those things, U.S. stock markets were mildly positive for the 2 weeks ended July 24th. Gold prices have kind of started to rise as some speculators see slowing economic recovery. Gold oftentimes is a place where certain groups of investors go when they're worried about the future. Gold last traded above $1,800 in 2011. It touched $2,000 an ounce yesterday on July 27th. Interest rates remain relatively low and unchanged as monetary policymakers just foresee keeping rates low for as far as the eye can see. And the TIPS market, which is kind of a measure of inflation, they're showing inflation projected under 2% also for years to come. At this point, of course, things can change, but that's where markets are today. Here's a graphic of those markets over the last 2 weeks. That yellow line, the level line on the bottom, is the bond market, which continues to do relatively well, provided returns well above the rate of inflation for the year, depending on what part of the market you're in. The two darker blue lines, or the dark blue and the light blue line, that represents broad stock markets, both in the U.S. and overseas, kind of a mildly positive couple weeks. At the top of the chart there, you'll see the green and the purple line. Those represent some equity asset classes that have been a little bit out of favor. Large value companies and small companies having a better 2 weeks, showing a little bit of sign of recovery. And then the orange line, the one at the top, that's gold prices. Gold prices did have a good 2 weeks as they've risen again to that high that hasn't really been seen since 2011. So here's a question. Summer vacation season. Many families are traveling in cars and more than ever in RVs, it sounds like, if we read the news, an attempt to kind of have a COVID-19 safe vacation or trip. And so the question that kids ask in summer vacation is, are we there yet? And I think I expect to hear this question a lot from investors and adults as well over the next few months. My answer is not quite. We only have 95 days to go, 95 days to go from August 1st until the election day on November 3rd. 2 weeks ago, I introduced a concept when we were talking about different kinds of risk called headline risk. It's a risk that I think is going to plague investors' psyche between now and November 3rd and likely beyond, as all these things that continue to kind of grab our attention and grab headlines cause us to maybe have some concern about what the future holds and wondering if we should be doing something different in the way that we invest or how we think about our financial plans. This week and in coming weeks, I'm going to return to this idea of headline risks and talk about some of the pressures that you might be feeling and how maybe you can think about them differently just to cause a little bit more calm, or at least give you some perspective on other ways to think about this, maybe than what you're hearing in the news or on social media. Speaking about how people are feeling about the election and investments, this study came out earlier this week by UBS. People are already wondering if they should be doing something about their investment portfolio based on the election. I like this quote from UBS Group CEO Sergio Armati. He says that events in the second half, particularly the US election, will trigger a change in investor sentiments. And then they did a study of some of their investors, and what they found is post-election, already 61% of their clients are thinking about changing their asset allocation. And then here's the key thought: no matter who wins. So people are looking at the future, they're thinking about the election, they're already going, I'm imagining I'm going to have to make a change in the way I'm investing, no matter which party wins the presidential office or possibly Congress. That doesn't say a lot for people's long-term investment confidence in terms of the plans that they have in place now if they're thinking about having to change something after the election, regardless of who wins. I think the reason for this is people tend to think about, well, which party is better for financial markets? In other words, when Democrats are in office, do financial markets do better? When Republicans are in office, do financial markets do better? We update a study at least once a year at Foster Group, just kind of looking at the performance of markets and who is in control during those market years. So this isn't a perfect representation of history, but the idea here is what we've done is we've gone back to the presidential years of Calvin Coolidge all the way through the years of Donald Trump, and we've looked at the return of the S&P 500 on a calendar year basis. And then we've looked at, well, how has the market done based on who's in control of different levers of government? So you can see here, if you're a Democrat, you're kind of happy to think about, well, if my person wins, when a Democrat is in control of the office of the president, the stock market has averaged 14.93% per year. Republicans a little lower number, 9.12. That number in the far right-hand column is the number of years that the Democrat or the Republican has held the presidency. So Democrats have held the presidency for 48 years, Republicans for 46 since the days of Coolidge. Now, if you're a Republican, you're going to like to look at the Senate and the House of Representative control numbers because they're going to make you feel better. Because when your party's in control of the Senate and the House, the market has tended to do better than when the Democrats are in control of the Senate or the House of Representatives. But the really interesting number, and I had to check this number so many times to make sure the math was right, but currently, if you look historically, if one party controls the presidency, the Senate, and the House, so in other words, if the Republicans hold all three or the Democrats hold all three, the rate of return for the S&P 500 is identical. Now think about that for a minute. That's almost like a statistical, unbelievable number, that a number could be the same, given that the Democrats have had all three levers of power 34 years since the 1920s. The Republicans only 13 years since the 1920s. But the rate of return for the market in those time periods that they had total control of all three kind of levers of power has been identical. I think the point of this study, and I come to it every year, is that really we all know that there's a lot more things going on that influence financial markets than basically who has the political power. There's things that happen before the election, things that will happen after the election. There's things going on globally. Certainly, it didn't really matter who was in office in terms of what happened with COVID-19. That was going to happen, at least in terms of the development of virus. No matter who was in office, the responses might have been different, but it certainly didn't have it wasn't caused by either the Republicans or the Democrats being in office. So as we think about, well, should I be thinking about my investments differently based on who's in office? One of the things that I'm going to say, looking at this chart, is no matter who's in office, historically, markets have done relatively well. And it's when we kind of get worried about the future and we start having some fears about, well, this time is going to be different. That's when we start to think we should be doing something different with our portfolio. So as I thought about that, I came across an article with a little hat tip here to Morgan Housel, who was writing, and he quoted an article from The Guardian 2 years ago. And in this article from The Guardian, Steven Pinker had done a study, and he was looking at other studies about, is the news getting more negative with time? And one of those data scientists who was looking at that subject was a guy named Khalid Litaro. And he applied a concept where he was able to look at kind of the negative news or the climate or the mood of the publication. And he was looking at the New York Times. And what he found was this: the New York Times got steadily more morose from the early 1960s to the 1970s, lightened up a bit, but just a bit in the 80s and the 90s, and then sank into a progressively worse mood in the first decade of the new century. News outlets in the rest of the world, too, became gloomier and gloomier from the late 1970s to the present day. So if you feel like the news is becoming more negative as you read it or watch it, at least in this study, that would say, well, you're probably feeling it correctly. Pinker goes on to write about another study in terms of how do people respond to increasingly negative news. He said consumers of negative news, not surprisingly, become glum themselves. As we read negative things, we get negative also. A recent literature review cited some of the consequences of that negativity, one being a misperception of risk or anxiety, lower mood levels, learned helplessness, contempt, and hostility towards others. This is kind of that polarization and division that we feel in the culture right now. Desensitization, and in some cases, people just shut it off, complete avoidance of the news. If you think about news sources today, both news media and social media, this idea of negative news and kind of creating senses of fear, and I think this phrase, misperception of risk, is a real risk for investors. Again, think back to looking at those returns, regardless of who's in office, Democrats or Republicans. If you're a kind of a staunch Democrat or a staunch Republican, right now it's likely that you feel that if your party doesn't win, markets are going to do horribly if the other party does win. And I think that would be a little bit of this idea of a misperception of risk, or at least the degree of risk based on the upcoming election. It causes us to become very fearful and to think we should take action. Housel, in his blog post about this Guardian article, he says this. He says, bad news gets more attention than good news because pessimism is seductive and feels more urgent than optimism. If you think about it, I really think we can all kind of identify with that kind of clarity of thought. Good news just doesn't grab our attention the way bad news does, and pessimism is seductive because it feels like, hey, something's bad is going to happen, so I need to act right now. But if we hear something optimistic, we go, oh, that's nice, and we just keep going along our way, feeling like I don't really need to do anything different. Jason Zweig, one of my favorite financial writers, he said this recently. He said, I think successful investing depends at most 10% on knowing what to do and at least 90% on knowing what not to do. And then I think this is the one to take away for this week. Most opportunities and techniques and strategies are tempting to act on. Again, it's that seductive nature of pessimism. But the more tempting they are, the more seductive the negative news, the more pressure we feel to act, the more likely they will turn out to be wrong. So I think the idea here with headline risk, particularly as it relates to the election, is as we move towards November, you're going to continue to ask yourself, are we there yet? Can this just be over, please? But the pressure, the pessimism, the negative news is simply going to continue to rise because both sides are going to use that negative pessimism to try to convince us that their side is right and the other side is particularly wrong. And as we get closer to that election, depending on how things look, you may think that no matter what, you're going to need to take an investment action. What history would say is that may not be true. While it's possible that this time around we might have a cataclysmic result as a result of an election. I mean, it's always possible that things may not work out as they have in the past. However, if you think about the past, going through depressions, recessions, world wars, global debt crisis, nuclear standoffs, double-digit inflation, the elections of both conservative and liberals, the idea that this time will be significantly different than past history. I mean, it could be, but markets have gone through and our economy has gone through a lot of difficult times very successfully for long-term investors. As we continue to go forward here in the coming weeks, we'll look at more news and more things that maybe we should be paying attention to and asking ourselves questions. Is the social media world and are the news media world telling us things that are helpful or just trying to get our attention? And what should we or shouldn't we be doing about it? Again, thanks for tuning in and watching these things from every couple of weeks. If you know of someone who you think we might be able to help, here's some contact information of how they can reach Foster Group. As always, we're just glad to have these conversations. We'd love to have them face-to-face, either via a web meeting or possibly even beginning to get together in person. Welcome those conversations. So please contact us if you're up for that. Thanks for watching, and we'll see you soon.